welcome to the weekly Saturday knowledge sharing webinar organized by Mehta and Mehta. Thanks for your continuous support. Our today's topic is Masterclass on NBFC. Today is this series' third webinar is there. The topic is an insight into prudential norms. Today's presenter is Ms. Nayan Handa, our Delhi partner. Today's our panelist is Mr. Vishal Solanki, Chief Financial Officer of JM. To formally introduce Mr. Vishal, is the Chief Financial Officer of JM, and he has spanning career of almost 2 decades in financial services. He has consistently demonstrated his experience and expertise in the area of financial planning, accounting, auditing, treasury, and taxation. He joined JM Financial Group in the year 2012 and has handled various functions, including financial planning and budgeting, finalization of accounts, representation of taxation matters, regulatory compliances, treasury, and working with internal and external stakeholders. Mr. Solanki holds postgraduate diploma in business administration and a bachelor's in commerce from Mumbai University. Welcome, Mr. Vishal. Thanks a lot for your time. Today's our another panelist is Mr. Hemant Pandya. He has around 18 years of experience across entire spectrum of corporate secretarial compliance and legal functions. His journey began in 2007 with JM Financial Group, where he is currently designated as the Executive Director, Compliance, Legal and Corporate Secretarial. In 2010, to pursue stint of practice, he joined Mehta and Mehta, and as a partner, where he served a diverse range of clients, including listed entities, MNC, FMCG, and financial sector institution. He holds a Bachelor of Commerce degree and law degree. He also a qualified CS and fellow member of ICSI. Welcome, Hemant.
Thank you, ma'am.
Today's our presenter is Ms. Nayan Handa. Nayan Handa, fellow member of ICSI, with various experience, expertise, and track record of in the field of secretarial and compliance of over 9 years of experience. Her proficiency extend to various areas and representing before various authorities. To she held our Delhi branch and she is a partner of Mehta and Mehta. Welcome, Nayan. Of course, our moderator, Mr. Bala, everyone knows. I do not would like to introduce him. Everyone knows him. With this, I thank all the panelists today's webinar for joining us on our knowledge sharing journey on behalf of entire team of Mehta and Mehta. Friends, we have thought over that in addition to Companies Act, LODR, CSR, ESG, BRSR, we would also like to share the knowledge on the various compliance functions which CS perform. And for that, the first one we decided of NBFC, and this series is started of NBFC compliance. And this is the third webinar for that. I really appreciate all the participants that you are enthusiastically joining this and sharing your knowledge and questioning and solving your queries. This platform is for that only. Today's topic is prudential norm. With this, I'll request Mr. Vishal to say a few words on the topic, then Mr. Hemant, then Mr. Bala, and then Nayan, you can start the webinar. Over to Mr. Vishal. Thank you.
Thanks, ma'am, for inviting me to enter Mehta and Mehta. So today's topic is very interesting, which is a prudential norm guideline. So everyone knows that this guideline is to ensure the NBFC's health and stability. So there are no much disturbance in the market or Indian economy. I would like to give some facts why it is so important for RBI or everyone to have this guideline, norms or regulations. So as we know, we have NBFCs around 9,200 or 9,300 crore around NBFCs in India, which is further divided into the base layer, middle layer, and upper layer. If we see the bucket of the base layer, we have around 8,700 NBFCs. In the middle layer, we have around 570 NBFCs, and in the upper layer, we have around 10, 11 NBFCs. Now, if we talk about the size in terms of the uh, amount, NBFC's asset size in India is 48 lakh crore, which is no doubt uh, it's very material amount, and we say it's contributing to the Indian economy at a great scale. Obviously, to the support to the in this rural and urban people, and it's clearly establishing that it's having a good role in the financial inclusion. Though NBFC like bank does not have benefit to have the demand deposit, but they have very well access of the funds from the public, which is through the loan from the banks, public institutions like mutual fund, bond market, insurance. So it's clearly we are saying it that they are accessing the public funds, and there are a lot of interconnectedness in the financial sector, and plus they have customer interface. So it is clearly that says that it's a systemically importance, and hence the rationale behind is that prudential guideline is very much important. So with this, I'll during the presentation I'll try to add a few more things as and when it is required. As of now, that's it. That's it from my side. Thanks. Over to the
Thank
Hemant,
you.
please.
Thank you.
Thank you, Vishal. Very nicely, you have touched upon the factuals, about NBFCs, how many NBFCs are there and how many are in base layer and why Prudential is important, Prudential norms. So, good morning, everyone. It's a pleasure to be among such a distinguished minds and sharing this with my views with you on Prudential norms is something, which I will also gain knowledge from, such important and distinguished experts. So, I was just thinking, if I wanted to introduce this Prudential norms, what is the simple way to introduce? So I was just thinking, so I thought, let me ask a question, what keeps a breach from collapsing, under pressure? So it's not just concrete, okay? It's the design, the load limits, and the regular checks. So in finance, financial sector, prudential norms plays the same kind of role. They are what we say structural safeguards, that ensure NBFCs don't buckle up, under the economic stress. uh, the term, if you see, prudential comes from prudence, okay, meaning caution, foresight, and sound judgment. These norms for NBFCs are not just rules, they are principles that help NBFCs operate responsibly, manage risk, and protect both their solvency and interest of their customers and financial system at large. So in prudential norms, when we are going to see, we will cover a lot of things like, capital adequacy, asset classification and provisioning, exposure limits, liquidity management, and all. So in a sense, if I have to say that, prudential norms are seatbelt for financial driving. Just to make, in a layman language, you may not need them every day. Prudential norms. I mean, we don't we track every day, but it's not needed every day. It's not, the importance will not be known every day. But when there is a fall, when there is a road, like seat belt, when road gets bumpy, okay, seat belt saves life. Similarly, prudential norm saves lives, when there is a fall down, like the crisis that we had recently in NBFC sector. So as we drive deep today, we will explore, a lot of things, from NBFC's point of view, what scale based regulations are saying, and we will be learning, a lot of insights, we'll be getting. Just to add, me and Vishal are from the same organization. So whatever we may be expressing our views, are our personal opinions and do not necessarily reflect, the organization that we represent. Over to you, Bala sir.
Thank you, Eman. Very nicely explained in a layman language. That is really helpful. Thank you. Yeah, Mr. Bala. Mr. Bala?
Good morning to you.
Yeah. Yeah.
I welcome you all on this seminar on my own behalf and also on behalf of Mehta and Mehta. First of all, I must recognize the experts who are actually today, they are going to share their practical experience. They are in the very sector itself. As practically, they are actually handling it. I think both of them have very nicely explained what is the concept, what is it. Only thing which comes to my mind is always any regulator is concerned about protection of the investors and again managing the risk very well and also making the liquidity available. That's the thing. So with this, what is happening is NPSC, if you look at it today, NPSC can do everything like a bank other than the banking operation. You can't only write a check and do the things, otherwise everything you can do it. That is the way it has actually come. So what people have done is here, the regulator, they have actually wanted to regulate this NPSC. So that is why they have actually divided in the different layers. Majorly, they divided in the 4 layers: base layers, middle layers, top layer, and upper layer. That's what they have divided. So as we travel along each layer, the compliance requirement has become stringent. Because base layer, what is applicable, will be applicable in the other layers also. But as we travel from base layer to the middle layer to the top layer, then stringency becomes more. That is the only thing is. Our thing today's discussion will touch upon all those concepts what Mr. Pandya has put up: capital adequacy, liquidity, risk management, etc., and other things and all. I think both the expert will keep adding their personal experiences. I think our presenter will take what you call the scale-based regulations as per the base-wise, so that to give a better understanding. With this, I ask Nain Honda to take the presentation over, please. Over to Nain.
Thank you, sir. Thank you, everyone.
Yeah, now it is perfect. Yeah.
So, good morning, everyone. It is my privilege to be here today and to speak on such a subject which is very important to maintain the financial stability in India in the NBFC sector, that is prudential norms for the non-banking financial companies. So when we talk about the NBFCs, we are still talking about the institutions that become a very lifeline for the credit in our country. So they have gone beyond the traditional banking now by reaching out to the segment that banks in our country. So often, banks find it very difficult to serve sometimes very small businesses, rural entrepreneurs, first-time borrowers, and individuals, with limited access to the formal finance. So in many ways, NBFCs has been, drivers for all the financial institutions and innovations in lending. But as the saying goes, like with great power, it comes with the great responsibility. So the rapid growth of NBFCs has also brought the new risk: higher leverage, exposure to the stress sectors, and the vulnerability. So in this governance and lending practices, and when we have, all seen how the failure of larger NBFC can send a shockwaves through the entire financial system. So it is in this backdrop that, Reserve Bank of India has strengthened its regulatory oversights, and it given the remarkable, journey from the time when, NBFCs operated under the relatively relaxed one size fits for all model to today's framework, that is scale based regulation. So which, keeps the norm to the size and very systematic importance for the NBFC. So this is not just a technical adjustment, it is a shift in the philosophy, we can say. So at the core of this, the regulatory framework lies with the prudential norms. And often this describes as the financial hygiene, as Hemant sir described, that had financial hygiene rules for the industry. And these norms are built around the 3 pillars that there is an income recognition. The NBFC has to ensure that only the book income which is real and received, not hypothetical income, has to be booked. And there is an asset classification which comes with the systematically identifying the stress in the loan accounts through the categories like substandard, doubtful, and the loss asset. And there is a provisioning when the NBFC has to set aside the capital, which is cushions in advance to absorb the potential losses. So alongside these, the capital adequacy requirement, like maintaining the minimum CRAR of 15%, it is designed to ensure that NBFC has the financial strength to, handle that shock, which, if something goes wrong happens. So in the recent years, RBI has gone the further, like they have introduced the reforms that aligns the NBFCs more closely with the bank to harmonization of the NPA classification of to a 90-day timeline is a big reform, such a reform we can say. So now this corporate governance standard and mandatory risk management committee, auditor rotation, stricter digital lending guidelines are there. So these are not merely the compliance checklist, but they are efforts to institutionalize the prudence, the transparency and accountability between the sector. So what does this mean for the industry? For smaller NBFCs, it raises the bar of compliance and pushes them to professionalize. For larger ones, we can say it demands the bank-like resilience, the governance, and the capital planning. And for the customer, it means more responsible lending and the greater protection. So, and for the financial system as a whole, if we talk about it, means to reduce the risk of contagion and stronger foundation for the sustainable growth. So as we move through this session, we will look into these aspects, like what are the foundational prudential norms, scale-based regulation, and other challenges and opportunities lies in this sector. So now let us understand what exactly the scale-based regulation or the frameworks we talk about for the NBFCs. So over the years, when NBFC sector has undergone the remarkable growth and there is a transformation, so we have seen that NBFCs increases in their sizes and expand into the diverse activities and becoming very deeply interconnected with the larger financial system. So with this evolution comes increasing risk is there, and naturally there arose a strong need for the regulatory framework which can keep a pace with these changes. And recognizing this, the RBI introduced the scale based regulatory framework with effect from October 1st, 2022. And this framework provides a structure of to classify the NBFCs, which is based on their scale, complexity, and the potential risk they held in the financial sector. So SBR framework is built on the four distinct layers. That first one is the base layer, which covers the smaller NBFCs operating at the lower scale, and these are regulated within relatively very tighter requirements are there. And then comes the middle layer and the upper layer. So which largely includes the larger and more significant NBFCs are there, and they are considered to be systematically important and hence are subject to the tighter regulation. And then finally comes with the last layer, that we have a top layer. And this is a very unique concept and it is ideally expected to remain empty as of now. There is no NBFC which is, falling under the top layer. And however, if the RBI finds that, there is a certain NBFCs in the upper layer, having very higher risk, higher systematic risk. So they they in themselves move the upper layer NBFC to the top layer and subjected to the stricter regulatory requirements. So as we all know, have a basic idea on the SBR and the layers of the NBFC. So let us look into the each layer one by one. So starting with the base layer, if we talk about, so it includes the NBFCs, which is specifically the all non-deposit taking NBFCs with this asset size below 1,000 crore rupees, and it also covers the certain specialized NBFCs, like peer-to-peer lending platform is there, and account aggregator, non-operating financial holdings companies. Additionally, the NBFCs which neither raise public funds nor have any customer interface and that are placed in this category. So these are considered low risk and hence subject to the least regulatory intensity. And next, moving to the middle layer, this is a very tightly regulated and includes all the deposit taking NBFC, irrespective of their asset size. It also includes a non-deposit taking NBFC with asset size of 1,000 crore and above. And within this layer, we find very important players such as standalone primary dealers, infrastructure debt funds, core investment companies, housing finance companies, and infrastructure finance companies. So these institutions are larger, deal with public money, and therefore they carry the big responsibility and the risk. Then comes the upper layer, which is reserved for NBFC, that the Reserve Bank identifies as systematically significant and needing the enhanced regulatory oversight. So the RBI applies a very scoring methodology to decide this. And importantly, the top 10 NBFCs in terms of asset size will always be the part of this layer, and regarding of other factors. So these NBFCs are subject to the much stricter regulation because of their potential to impact the financial system as a whole. And additionally, the very top layer, like about the top layer, and this is expected to be remain ideally. And RBI, believes that certain NBFCs in the upper layer, they have some very high systematic risk, due to which their complexities and activities may be moved up to this top layer. So once there will face the most stringent regulatory requirement, so they will shift the NBFC from upper layer to the middle layer. Sorry, the top layer.
Nine, I think as on today, there is nothing is in the top layer at all.
Yes. As of now, there is no NBFC.
Everything is only in the upper layer.
Upper
So
layer.
in the scale based regulation also they have written that way only, that they want that it to be remain empty unless they find something extreme
Yes.
systemic risk.
So now, as we have, understood like about the basic layered structure of what the NBFCs has and NBFC regulation has. So let us, go with the important concept of today's presentation, that is a prudential regulations. So prudential regulations are essentially, these are the rules, which are prepared by the Reserve Bank of India to ensure the financial health of the NBFC. And the idea is very simple, to protect not only the NBFC themselves, but also the depositors, the investors, and ultimately the financial system as a whole, not just the NBFC. So under this scale-based regulatory framework, the potential norms are different at each layer: base layer, middle layer, top layer. So the higher on NBFC is placed, the stricter the norms become. For instance, if we talk about the base layer, the requirements are relatively light and given their smaller size and limited in the public interface. So if we talk about the middle layer norms, the norms becomes tighter and covering the aspects which is like capital adequacy, governance, and liquidity. If we talk about the upper layer NBFCs, it face the strictest regulation and includes the enhanced disclosure standards, higher capital requirement, and the governance check. So, in the specific prudential regulation that applies to the base layer NBFC, the first ratio is the leverage ratio. And for NBFCs in the base layer, the leverage ratio is, the ratio of the total outstanding outside liabilities to the own funds, which cannot be exceeded at more than 7 at any point of time. So this, give the assurance that NBFCs don't, excessively rely on the borrowings, and it maintains the very healthy balance sheet. Of course, these are exceptions for the microfinance institutions and higher layer NBFC, but the rule is very strictly applicable to the base layer NBFCs. And the second key requirement for the prudential norms for the base layer is, regarding the tier 1 capital. So for NBFC, which is primarily engaging in the lending against the gold jewelry, a minimum tier 1 capital of 12% of the total risk weighted asset must be maintained. And this includes, both on the balance sheet and off the balance sheet items. And it is aimed at ensuring that such NBFCs has a strong capital base to absorb the risk. And the third most important aspect is the income recognition. So here RBI, laid down some clear principles where it says the income recognition must follow the recognized accounting standards, and interest, discounts, higher charges, lease rental, or any charges or NCO can only be recognized when actually realized. And if such income was recognized before an account becoming non-performing and remains unrealized, it must be reversed. And in cases where loans are under moratorium, interest income can still be recognized on accrual basis as the account is classified as standard. And if loans under the moratorium later than the NPAs after the moratorium period, the capitalized interest accrued during the moratorium needs to be reversed.
So just to add in the previous slide, uh, when you say, just to explain, what is tier one capital in a very layman term, because most people may not be well versed with NBFC sector, and Vishal, you may also add in this. So for NBFC, tier one capital is nothing like but a core capital, the main capital of the financial institution. This is essential. Essentially, it's strongest and most what we say a reliable buffer kind of thing, against financial stress. So tier one capital is very much important. It includes like equity shares, retained earnings and other comprehensive income, and also that is how it is. And it is try this is why it is required. It can absorb loss. So for absorption of loss, generally it is required. So that is why they insist on this much minimum amount of tier one capital is required. And when you say leverage ratio, so if I want to explain leverage ratio in a very simple term, it is a financial metrics, to quantify or find uh, how much debt an NBFC is using to finance its assets. So this helps to measure the financial risk and stability of the NBFC. Vishal, you may want to add more, because
Yeah, yeah.
Vishal is into this thing, day to day he manages. And Vishal,
Correct,
I
correct.
would also request, if you can do a little out of this topic, but I always find Vishal doing a lot of interesting things, because he's the CFO. So as a CFO, it is very different, to be an CFO of an NBFC. How different it is, and what Vishal has to go a lot of different kind of roles. Vishal, you may also add what kind of things you do in general, so people may know how interesting it is to be an CFO of NBFC.
Sure, Hemant. So, just to add on the Hemant's tier one point, tier one capital. So, this is tier one capital is obviously important because this shows that the strength of the organization and how much loss which can be absorbed and which can be um, uh, which is minimum capital to be maintained by the NBFC, which can be taken care. So this is just tier one. One is just the reporting, and second is if you go to the advanced stage, which is also the planning, which obviously comes in the ICAP assessment. So in the tier one, I'll just add that which is the net worth of the company, which is as he rightly said, the capital plus premiums and plus the return earnings of the year on years. But it also removes the unrealized portion of the balance sheet, which is like intangible assets, like deferred tax asset, which is just the book entry, but which doesn't have any tangible asset nature. So the regulator is asking from the network to remove it from the tier one capital, which also ask us to remove the unrealized gain, which the company who are following Ind AS, where it is required now to be also accrue the unrealized gain. Suppose you have some financial instrument where you have 100 rupees of cost, but at the reporting date, suppose that becomes 102. So Ind AS required that you recognize 102 in the book by booking the 2 rupees of the income. But while calculating the tier one capital, regulator has mentioned in the regulation that those 2 rupees you need to remove it from the tier one capital to make it actual or which is more realistic capital. So that is the tier one capital. Leverage ratio is obviously important for organization, for the stakeholders like rating agencies or your borrower lenders like bank or mutual fund. So many a time this leverage ratio, they one of the criteria they have for assessment or to check the health of the organization, and plus to see that what is the additional appetite company has to grow, because obviously we need to maintain 15% capital adequacy ratio. So you can go below 15%. So if you are at 25%, lender can assume that you have more appetite to do the business, so you can borrow. But If you are like closely at 18%, then it needs to be monitored very closely that it should not breach. So this leverage ratio is very important. Rating agencies put it in the say rating rationale where they say that though you are allowed to have say 7 times, but looking at your nature of the asset, the segment where you are lending, we appreciate that you don't go to the maximum scale, but you restrict yourself. What your management view is on that. So, basis that they consider the rating also. So, yes, Hemant point is right. These two things are very important to understand this. And apart from this, what Hemant is saying as a core, my role, what I am doing is so sometimes it's reporting is one thing, but to have the planning, like we in our finance role, we need to do the lot of projections, we need to do the lot of pre-planning, how we will see organization 1 year down the line or 2 year, 3 year. So suppose the management says that we need to reach the scale of the asset from suppose 10,000 to 15,000 or 5,000 to 10,000. So how the balance sheet will look like, how much we need to borrow, how the capital adequacy ratio will look like that time, whether company will need the infusion of the capital. Those kind of planning involves in my role. So this is a brief about the. Thanks, Eman. Thanks, everyone.
Vishal, when you touched upon the Ind-AS applicability, in fact,
Yes.
if we look at the regulation,
Yeah.
regulation actually says 500 crore and above net worth to the Ind-AS is applicable. And also in case of the listed companies, that means any debt or equity which is actually listed irrespective of the net worth, even that is
Yes.
applicable. This is what it is saying. But at the same time, correct me if I'm wrong, because when you say Ind-AS is applicable, then equally, what happens is these companies have their subsidiaries, holding company, joint ventures. Even though they may not fulfill those requirements of the criteria for the Ind-AS, but just because the NBFC, which is actually having a Ind-AS applicability, then in those subsidiary, joint venture, holding company, also the Ind-AS will be applicable. Am I correct?
Yeah, it is applicable. Yes. Only thing is under Ind AS, there are two kind of format going on in the Schedule 3. So the company which are not directly related to the BFSI, but they have Ind AS applicability, they have some little different format to follow under the Schedule 3 of the balance sheet. And for this, like they have current non-current asset disclosure like this. And in NBFC, their format is like financial asset and non-financial assets. But yes, they have to
Yeah,
follow.
absolutely, you're right. One thing. Another thing is there, whenever the Ind-AS actually comes to the picture, Ind-AS, apart from the compliances, more of the disclosure which will be called for actually as per the Ind-AS requirement in all the cases. Although you are required to follow the RBI regulations, but the
Yes.
disclosure will come as per the Ind-AS. Yeah.
Disclosure will come, and apart from this, like suppose I'll take one example of the expected credit loss. So now
Yeah.
under the RBI, it was like can say it was like incurred loss methodology is there, where suppose at the standard asset you need to follow for the middle layer 0.40%, and for the if it is an NPA then 10%, 20%, 30%, 50%, and loss asset 100%. Ind AS is saying that though it is a standard asset, you need to bucket it in the stage 1, stage 2, stage 3 assets. Basis the DPD, which is the overdue days, and also some qualitative factor. Now, if assets is stage 1, stage 2, or stage 3, each NBFC is expected to have their own ECL model where they have to consider probability of default, then loss given default, and they have to come out with the provisioning. So that is why if you see the all the peer NBFCs, their RBI provision as per the RBI and the provision as per the ECL is always higher. But one good thing is to understand the people. RBI has came out with a disclosure in the balance sheet where each company has to give the various staging of the asset. And apart from this, there are two columns which shows provision as per the RBI, which is required, and provision as per the ECL. So people understand the minimum which is RBI expecting is companies carrying that provisioning. So that is the main gap where, apart from the disclosure, it will come into actually in the accounts, and the figures will get changed to that extent.
I think company secretaries who are being there, we are running away from the accounts. So many a time they should also understand when it's come to the disclosure requirement, we are equally responsible for ensuring the compliance. And that is why I raised this question actually. Because if you look at it, many people will agree in this forum also. We always think, oh, it is a finance. Oh, it is Vishal like people who are a CFO, they are in charge. We are not. That sort of thinking is there. That has to actually change because when it comes to disclosure, we are equally responsible in the disclosure because the accounts are also covered under the Companies Act, we being a compliance officer. Yeah.
And just to add on that, basically the synergy between the finance and compliance team or secretarial team nowadays, both are working very closely because something which is happening in the account, suppose, which requires a lot of policy and committee to take the noting and everything. So the working in the silo cannot work. It has to be integrated approach and whatever the accounts or finance team do any action, it has to be with the prior approval of the respective committees or board, and there are policies required for this because this is the experience from the statutory or the internal auditor or the regulator. There are a lot of things they ask about the first the approvals and governance structure, and then they came out to figures are kind of function of those decisions taken, but the decisions fall from where, decisions taken by whom, those are very important. So secretarial compliance team, it's very important that they we need to go to them and get it approved from the board and respective committee, place it before the committee, and then so that's why I'm saying it's a very integrated approach, and it has to go hand on hand. It cannot be working silo that what accounts has done, secretarial doesn't aware about anything.
Well said, well said, well said. Yes, go ahead, Naim.
Yeah. So now we look into the how this income from investment is recognized by the NBFCs. So firstly, there is a dividend income. So dividend from shares and mutual fund, they are generally recognized on a cash basis, meaning only when the dividend is actually received. And however, there is one important exception when the dividend is declared at the AGM of the company and the NBFCs. The right to receive the dividend is confirmed. So then it can be recognized on the accrual basis. And secondly, income from the bonds and the debentures of the corporates or the government securities. So this income is recognized on an accrual basis, provided like two conditions has to be met, like the interest rate is predetermined and the interest payments are being made regularly without any arrears. So these, thirdly, there is an income from the securities of corporate or public sector undertaking. So where both interest and principal repayments are guaranteed by the central or the state government. So it is also recognized on an accrual basis. So this principle is like here is simple and certainly and regularity of the payment decided whether the recognition is on cash basis or the accrual basis. So this ensures like the NBFC reflects a fair and prudent picture of their earnings and the investments.
Somebody is putting a question. Tier 1 capital is to be maintained throughout the year or only at the year end?
It is throughout the year.
Throughout the year.
So now, as we understood about the basic principles, how the income has to be recognized, and let's now discuss about the very critical pillar of prudential norm, that is asset classification. So as you see here, there is a this is where NBFC categorizes their loans and advances based on the health of the account. So the RBI mandated a clear classification system into the four categorization, that is standard, substandard, doubtful, and the loss asset. So the standard asset is an account with no arrears and where everything is being paid on time. So this is where we want our loans to be. And however, once a loan shows a sign of weakness and it becomes a non-performing asset or NPA, so it gets classified further. That is a substandard asset. A substandard asset is a loan, that has remained an NPA for a period of up to 12 months. And this is on account with some stress. And if the stress continues and account remains an NPA for more than 12 months, it is classified as a doubtful asset. And finally, a loss asset. Loss asset is one that NBFCs or its auditor has identified as uncollectible, even though it may not have been completely written off. So a very important rule is highlighted on the side. The slide is that the asset cannot be simply upgraded from a worse category to a better one, just because on the terms have been rescheduled. So it must demonstrate the satisfactory performance under the new terms of the for the upgrade to be valid. So this brings the third and third and a final pillar of this IR ACPA framework. Like RBI mandates the NBFC as a side portion for this. And now, as you can see here, the classification of assets we have already discussed, that is standard assets and then doubtful assets, substandard assets and the loss assets. And the standard asset again, where there is a no default in repayment. Then comes the doubtful asset, substandard asset, where the classification as a non-performing asset for a period of not exceeding 18 months, and an assets with recognition, renegotiation scheduled or restructured terms after the operations begin until 1 year of satisfactory performance under the new terms. And then comes the doubtful assets, a term loan or lease assets or a hire purchase asset or any other asset which remains a substandard asset for a period of exceeding 18 months. So this is how the asset has to be classified. And then comes the loss asset, when the asset which has been identified as a loss itself by the NBFC, it is internal or external auditor, RBI, and the adversely affected by the potential non recovery due to the scrutiny, erosion, and absence of the borrower fund. So anything if you would like to add in the asset recognition?
No, Nine, you can go ahead. Panelists will add as and when they feel like adding it. There's no problem. They will step in because they have been actually said that whenever they feel like adding any value addition, they will automatically get it. Yeah.
Yeah. So as we have focused on the NPA classification and the two new timelines for its implementation. So as you see here, an asset is a non-performing asset when interest remains unpaid beyond a certain period. So as you see, there is a historical or a general definition of 180 days. However, this is no longer the case, and the regulatory environment has changed significantly. And the NPA classification norm has been revised to a 90 days overdue period for all the NBFCs, so which aligns their standard with those of the commercial banks. So this is a major change, and it has been implemented in a phased manner to give the industry time to adjust. So the glide path for this is clearly shown here. So by March 31, 2024, overdue become 150 days was to be classified as an NPA. And so now this period has been become, accounts become NPA if the overdue beyond the 120 days. And by March 31, 2026, the final harmonization standard of 90 days will be fully in effect, making all the accounts overdue beyond the period of non-performing asset. So if a loan account of a borrower becomes an NPA, all the facilities extended to that borrower must also be treated as the non-performing asset. So this borrower-wise classification rather than account-wise is a very important aspect in the new rules. And this moves towards a stricter 90-day timeline, forces the NBFCs recognizing the potential losses much earlier and demands to, more disciplined risk assessment and collection practices. So it is very powerful, tool by the RBI to ensure that the financial system remains intact and institution present more accurate and timely pictures of their asset quality.
So here, just I want to add, there are few NBFCs, which are required to continue with 90 days, earlier, are still required to do 90 days and not 120 days. Vishal, you want to add on this?
Yeah, Hemant, that is middle layer. This is they are talking
Yeah,
about base layer. So base layer starts
NBFC,
with 180 and then gradually they
correct,
are moving to 90 days
correct,
in 2026.
correct.
But slowly they are actually bringing the risk management in the phase manner, even at the base layer, and they are making it little more stringent by phase. That's what it looks like. Yeah.
So now, as there is a concept one that is SMA special mention account, and the key norms related to the loan payments, and as here we can see the payment is considered overdue if it is not paid on its due date. And to ensure the transparency, the RBI mandate that the loan agreement must clearly specify the repayment date, frequency, and breakdown of the principal, interest, and the borrower must be informed that these terms at the time of sanction and again during any changes or renewal to the loan. So this is a crucial early warning system which is introduced by the RBI, that is a special mention account classification. And this is designed to identify the stress in a loan account before it becomes full-fledged NPA. And this here you can see that SMA 0, this is an account where the payment is overdue for up to 30 days. And then comes the another category, that category, that is SMA 1, which is an account is classified as SMA 1 if a payment is overdue more than 30 days, but up to 60 days. And then comes the SMA 2. This category includes the account with the payment overdue for more than 60 days, but up to the threshold for NPA classification, which is we have discussed in previous slide, that being phased down to the 90 days. So now here it also states that the period of SMA 2 shall be adjusted as per the glide path, which is very important. And there is a different references to the phased implementation that we have just covered, where the final 90 days overdue period will be in effect by March 31, 2026. And so this SMA classification is the regulatory tool, which is, by compelling NBFCs to recognize and report even a single day of payment default. So the RBI ensures that stress signals are identified early, and this allows both the lender and the borrower to, take the corrective action before the situation escalate into the NPA, and thereby protecting the financial health of the NBFC and the credit history of the borrower.
Just to add this here in the SMA things, so each NBFC need to report asset classification to the RBI. So there is one return which is CRILIC return which is going monthly, where all the asset classification of the respective large loans which are more than 5 crore is to go there, marking them as a standard, substandard, doubtful, SMA 1, SMA 2. So that about the monthly return. Apart from this, for this SMA 0 category, which is payment overdue up to 30 days, there they have introduced one more return, which is a weekly return, where the first default of the client for the first day, every Friday cutoff, NBFC is to report by next Wednesday, which is called as a fresh default. So in the RBI domain also it goes now the fresh default even of the one day. Earlier it used to go monthly, which was SMA 1, SMA 2 only. So these are the latest change where each NBFC has to file the weekly return as well today.
So just to add, in simple terms, why SMA 0, SMA 1, and SMA 2, how it helps. So SMA 0 is nothing but an early warning signal, borrower may be sleeping. That is what SMA 0 says. SMA 1 is like, it is like, it gives a picture that there's a moderate stress and needs follow up. And SMA 2 is like, this is the highest risk, close to NPA category. So that is how people track SMA 0, SMA 1, and SMA 2.
And this CRILIC return access, ultimately, where whatever the NBFC file to the RBI, the access is to the bank. So whenever the borrower approach to the lender, to the banks for the term loan or whatever the facility, they pull out the CRILIC report, which bank has have the access. NBFC not yet have the access, and they easily come to know that this borrower who has applied the loan to us is already say this many DPD either in SMA 1, 2 or NPA or DPD 0. That is, they will able to get the information from that report. That is the ultimate objective of this report.
They given the specified framework of the form or something like that for
Yeah,
reporting.
yeah, so there is one form which is in the structured format. It goes where it asks the PAN number of the client. The name will get automatically pull out from the NSDL PAN number link in the RBI domain. But few more information about the like what is the sanction amount, the client loan amount, then outstanding amount, whether it is an interest outstanding, what is the DPD going on, which
Oh,
sector it belongs. So those kind of various fields are there in the return.
okay. Okay, they have given the specified format. Okay.
Yeah, yeah.
So now, as you know, we have two crucial aspects of the regulatory framework. We have understood that the real-time nature of the asset classification and the rules for upgrading an account. So the first point is account are marked as overdue or SMA, NPA or NPA at the end of each day. So it is a key detail and that it reflects that RBI moved towards a more dynamic and the real-time classification system, which ensures the NBFC cannot delay the reporting on of the stress assessor. So the NPA or the SMA classification date is the calendar date for which the DN process is run. And the second point is upgrading from NPA to the standard asset is a very important rule that shows how an NBFC can improve the health of its loan portfolio. And as the as shared in the slide here as well, that the NPA can be upgraded back to the standard asset only if the borrower clear all the overdues interest and the principal. So this applies to all loans the borrower has with the NBFC, not just the one that becomes the NPA. So the borrower wise approach is a critical part of the RBI frame, preventing the NBFCs from simply reclassifying a loan without the borrower addressing all their outstanding dues. And it put importance of consumer education on these topic as well. And so the RBI requires NBFCs to put a very clear explanations on their websites and their branches about what it means for an account to be overdue, what SMA, what NPA classifications are, so how the loans can be upgraded. So when NBFCs are also mandated to train their frontline staff to explain these concepts to the borrower when they are giving or renewing the loans. So this focus on how RBI brings the transparency and the customer awareness is a core part of the RBI's objective to protect the consumer interest as well. So as we have covered few principles of the income recognition and the detailed process of asset classification. So now there is a third pillar of the IRACA framework, which is the provisioning requirement. So as you see, the provisioning is a foundational practice where NBFCs are required to set aside a certain percentage of fund as a cushion against the potential losses from their loan portfolio. So this is a core part of a prudential norms, which is designed to ensure that the financial soundness of the institution and it protects the interest of the investors and the lenders. So the RBI mandates that the NBFC must make provision for accounts that are classified as substandard, doubtful, and the loss asset. So the required provisioning rate is not a fixed number; it increases with the risk level of the assets. And the rationale behind this is very simple, that RBI want NBFC to be financially prepared for the potential losses. As here, we can see the provisioning account for the time lag in recognizing the non-performing asset account and any potential erosion in the value of security backing the loan. So the provisioning rate can be range anywhere from 15% to as high as 100%, depending on the category of the asset. With the higher risk category, such as doubtful and the loss assets, necessitating the greater provisioning to reflect the increased likelihood of the non-recovery. So it is also worth noting that NPAs, to the in addition to the NPA, that NBFC are also required to make a provisioning against their standard assets, so which are the healthy loans, and albeit at a very much lower rate. So RBI has progressively increased this to 0.4% in a phased manner. And in essence, we can say the NBFC has to maintain a realistic view on their financial health and ensure that they have a buffer to absorb such shock without, affecting the entire company. And it is this critical step that, transforming the risk identification into the tangible financial safeguard and strengthening the entire financial system.
Somebody has put up a question: will the security be valued every financial year, end, and provisions made or adjusted?
What I understood, security means they're asking collateral. So,
Yes.
yeah, so if it is a collateral, yes, it needs to be value as per the loan policy also. So it depends upon the security. If it's a liquid security, which is a capital market related, then it has to be more frequent rather than yearly. If it is a illiquid security like real estate something, then the board can have the policy of yearly valuation. That is one. Second is provisioning. Yeah, if it is a bad loan and if it is a shortfall in the security, then it is called as a loss asset. And if it is a loss asset to to the extent of the unsecured amount of the loan, it has to be provided 100%, and the rest can be depending on the which category it is. If it is a doubtful, then it has to be like 20%, 30%, 50%, depending on the doubtful 2, 3 status.
Somebody put up a question: pro forma financials, NBFC should be the same as of corporate entities.
Yeah, it is the same because say uh, if it is a corporate, but as again I said that corporate belongs to the banking financial. Like suppose it's an insurance company or the kind of investment banking or securities related company, SEBI registered companies, or if it is an NBFC, then there is a Schedule 3 which is having the financial non-financial asset format. And if it is a corporate falling Ind AS but not belong to the banking financial, those have their own format under the Schedule 3, which is kind of current asset, non-current asset kind of thing.
Somebody is actually asking you to give the examples of tier 1, 2, 3 companies so that he can understand. That's what they're saying, something like that.
Tier 1.
Tier 1, 2, and 3. He is asking some companies example.
No, tier 1. I guess there's no tier 3, tier 1 and tier 2. So
Yeah.
tier 1 capital, what we have just seen there is the net worth of the company, and we need to eliminate certain things, kind of intangible assets, unrealized gain. Plus, if you have investment or loans given in the group company, so to the extent of more than 10% of your own fund, you need to remove it from the computation and to arrive at the tier 1 capital. And this tier 1 capital, we need to compare it with the risk weighted asset, which is the balance sheet asset size. And then we need to come out with the percentage where regulator is saying it has to be like 10%, 20%, 12% minimum.
I think the moment he puts the example, I think probably he's expecting to give the name of
So
the
the question
companies.
is
So
question
something.
is wrongly asked. Question is there is no tier 1, tier 2 companies,
Companies.
but it is capital. So
Capital.
Okay.
what Vishal is rightly saying, what is tier 1, tier 2, but just basically if I want to tell in a layman language what is tier 1 and how tier 1 and tier 2 are used. So tier 1, a tier 1 capital is nothing but a core capital, which I said, most reliable capital for loss absorption. Tier 2 is like supplementary, or which is less secure. When you say loss absorption, if something loss comes, how to so tier 1 capital can immediately help to absorb the loss. Tier 2 can be a secondary way of doing it. Examples I gave you for tier 1 was equity and retained earning and related things. Tier 2 capital is nothing but subordinate dates and other reserves. So that is how it is. So tier 1, tier 2 capital are tier 1 is the most important capital. Tier 2 is the secondary part.
Okay. There are
And in
some more
tier 2,
questions. Yeah.
tier 2 they are also allowing the standard asset provision, which is 0.40%. So RBI is allowing 0.40% in tier 2 capital also to keep it and to increase the capital.
How much percentage of the loan a base layer company can give?
So it is there is written in the regulation for base layer that it is board to decide the limit per party, and I think it is also written in the circular that you have to draw the reference from the middle layer regulation where it is says that 25% of your net own fund you are allowed to give as a single party either in the form of loan or investment, and 45% to the group.
As per the SBR regulation, NCD, CR are part of the tier 1 or 2 capital.
NCD, which NCD? Because there are redeemable NCDs. Those are not part of the tier 2 because those are the purely borrowings. And if
And
NCD raised for the subordinate debt, as a subordinate debt, as rightly Hemant said, if it is a subordinate debt, which are those are allowed with some conversion factor in the tier 2 capital.
he is also saying CCPS.
CCPS, I guess it is allowed, yes, because
Okay.
it's a compulsory convertible preference shares.
So one more thing I would like to ask on add on the base layer question that someone how much loan a base layer company can give. So what Vishal said is correct as per policy, but one more important factor that it is to be kept in mind for qualifying as a base layer. There are two things: you should not have public funds, and second is you should not have customer interface. The moment you have customer interface, you cannot say that I'm a base layer. So that is also very important.
Somebody puts up the question, what report goes to the RBI and the payment of the interest on the bonds? I think interest on the bonds, any report or what only you are
No, no,
saying, it's only a default, isn't it?
Best of my knowledge, there is no any report required to be sent to the RBI for payment of the bond because there is for NBFC it's an ordinary course of business. Only thing is if
Correct.
it is listed, then secretarial team is sending intimation to the
Yes.
exchange, I guess, and to the rating agencies from the
Yes.
finance team side that these are the obligation was coming and we have we have complied the obligation.
Whenever you apply for the registration of the NBFC, the form is asking the company application as a type 1 or type 2 tier in relation to the deposit taking and non-taking. Is it right? Whenever we apply for the registration of the NPSC, the form is asking the company application as type 1 or type 2 that relates to the deposit taking or non-deposit taking.
So, type 1 NBFC is nothing but NBFC which does not have public funds and public this thing no customer interface. So that is how it is. And type 2 NBFC are normal NBFCs.
Okay. Somebody is putting a question here. I think probably that earlier question what he talked about the example. I think his question is something different. He is asking, for example, Shriram Finance Limited, Mukut Finance, and Bajaj Finance comes under which layer and which tier?
So that will have to evaluate. We may not know.
I think
It
this
depends on the asset size. If it is more than 1,000 crore, it is middle layer NBFC.
I think if it is a Mukut Finance, I can definitely tell you it is the top layer.
Yeah.
That I can definitely tell you. That is one thing. Second thing is I put Shriram Finance and Bajaj Finance. They are also coming at the top layer only, I think.
Correct.
Yeah.
Correct.
There's all the three companies what he mentioned is coming as a top layer only. Yeah.
So those are upper layer. Bajaj
Equal layer.
Finance upper layer.
Yeah. Sorry, upper layer. Sorry,
Yeah.
top layer. There is nothing. We said top layer is empty. I stand corrected. Yeah.
Yeah. Muthoot is also upper layer.
Yeah. Right.
correct.
Upper layer. There is no top layer because we said
Yeah.
initially. I stand corrected because
So
somehow I
Shriram
took it.
Finance is deposit taking NBFC. Shriram
Yeah.
Finance, if I am not wrong.
Because I took it actually the top one, so the last stage. That is why I think I stand corrected to that extent.
Yeah. So in upper layer there are 11. Out of those 11, 3 are taking the deposit taking, which is Bajaj, Mahindra, and Shriram. Those are the
Okay.
deposit taking NBFCs
Correct.
among the upper layer.
Somebody says, actually, could you please interface the customer interface? Customer interface, even last time also, it is well explained actually. If you have a customer, if you are having a regular interaction, then there's a customer interface. I suggest the person to go through the recorded webinar of the last time to understand more. It has been elaborately discussed last time. Yeah. Go ahead, Ryan. It's already 12 o'clock. Huh? You know to go. I think you have a lot of things to cover.
Yes, yes.
Yeah.
So as you know, your provisioning is a foundational practice where NBFCs are required to set aside a certain percentage of funds as a cushion. So, against the potential losses from their loan portfolio. So the RBI mandate the NBFC must make a provision for accounts that are classified as substandard, doubtful assets, and the provisioning rate is not just fixed number, it creates with the risk level of the assets. So now look into the specific which is shown here in the slide, that for a loss asset which is considered uncollectible, the NBFC must either write off the asset entirely or make 100% provision of for it to remain on the book for any reason. And for a doubtful asset, the provisioning is more announced, and the slide breakdowns here as the into the two parts. Like for the unsecured portion of the asset, which is the part of the loan not backed by any collateral, the NBFC must make 100% provision for it. And for a secured portion, the provisioning is based on how long the asset has been in the doubtful category. So, as the table on this it shows that provisioning rates start at 20% for an asset that have been doubtful for up to 1 year, which is increasing to 30% for those between 1 to 3 years, and it goes beyond to 50% for the asset that have been doubtful for more than 3 years. And lastly, for the substandard asset, which are the loans that have been NPA for up to 12 months, this indicates a general provision of 10% of the total outstanding amount. So here we can note that, in addition to these non-performing categories, NBFCs are also required to make provision against their standard assets. So which are the healthy loans. And this increased to 0.4%. And in this is the disciplined approach that NBFC has to maintain for their financial health. So now, as we have covered the general provisioning requirement for the loans and the other credit facilities, now we look into the category of the assets, that is hire purchase and the lease assets. So these financial products are unique, and as such, the Reserve Bank of India has prescribed a distinct set of provisioning requirement for them to ensure the proper accounting and the risk management. And the first point under the hire purchase asset address how to handle the total dues, which include both the overdue and the future installment. So NBFC must prudently deduct the unmatured financial charges, which are essentially the financial charges that have not been credited to the profit and loss account. So in simple terms, we can say there is a rule to ensure that NBFC does not book income on a loan that has yet to be fully paid. So this specifies that the underlying assets provisioning must be made for the depreciation with the clear rate of 20% per annum using the straight line method. For the second hand assets, the rule required using the actual acquisition cost for this calculation. And here we can see that additional provision for the hire purchase and the lease asset is a tiered system that reflect the increasing risk of non-recovery over time. So the principal provisioning under the RBI, where the required provision escalate the assets higher health deteriorate, as you can see here, for assets that are overdue up to 12 months, no additional provision is required. And however, once an asset is overdue between 12 to 24 months, a provisioning of 10% of the net book value must be made. And this provision jumps significantly to the 40% for the assets, which has overdue for 24 to 36 months, and then 70% for those overdues between 36 to 48 months. And finally, for an asset overdue for more than 48 months, the NBFC must make 100% provision of the net book value. So Under Section 62.66.6 2.3 reinforce that discipline, by stating that after 12 months from the last installment is due, 100% of the net book value must be fully provided for. So this specific rules, when combined with the general provisioning norms, that can range from 15 to 100%, it depending on the asset classification, which demonstrate the RBI's commitment to ensuring the NBFC has a robust and honest reflection of their financial position. Now we have just completed our detailed discussion on the provisioning requirements. So now we are shifting our focus to the specific guidelines and the framework that the RBI has issued to manage the unique and often challenging situations in the NBFC sectors. And this, we are trying to cover the snapshot of how this RBI master direction go beyond the general prudential norms to address the wide range of scenario from resolving the stress asset to the providing relief during the natural calamity. So, the first here we have covered the paragraph 18 of the SBR. It is that is the prudential framework for the resolution of the stress asset, and this framework applies to the larger NBFC, which is specifically all the deposit taking NBFCs and non-deposit taking NBFC with the asset size of 500 crore and above. So these are the crucial guidelines given a structured process for those systematically important institution to handle the loan account and that are showing signs of the stress. And in the next para 19, there is a framework given for the compromise settlement and the technical write-off. So this framework applies to all the NBFCs regardless of their sizes, and it sets the rules for how NBFC can settle account with the borrower for less than full amount, or how they can technically write off a loan by having a clear and the universal framework. So the RBI provides a standardized approach for the NBFC to manage the non-performing asset that are difficult to recover. Under para 20, there is a outline the guidelines for the relief measures in area which is affected by the natural calamity. So, which is important framework that demonstrate how this RBI plays a role in ensuring the financial institution act with the social responsibility during the crisis. So, these guidelines are applicable to all the NBFCs in affected areas and providing a standardized set of instructions on how to offer the relief to borrower those ability to repay the loans has been impacted by the natural disaster. And following to this paragraph. 22, the slide we have covered the norms for restructuring of the advances, and there is a guideline specifically for the non-deposit NBFC. Non-deposit taking NBFC with an asset side of less than 500 crores. So this is a very important detail. As you can see, RBI has a tiered approach or even for the specific rules. So there are separate norms for the smaller NBFC. So RBI, given the unique business model and tailored the regulation to their scale. So which is a core philosophy of the scale-based regulation. Due to the time constraint, we have not covered each and every circular. So we have just given the brief of those important guidelines and the framework, which is given under the prudential norms to be taken care when, there is a natural calamities there and anything comes up. So how to deal with those, I said, the RBI has given the circulars.
There is somebody has put up a question.
Yeah.
ESOP reserve capital redemption reserve to be considered as a calculation of CRER.
Capital redemption reserve is part of very well tier 1 capital only.
Okay. He has put ESOP reserve.
ESOP reserve is also part of tier 1 only.
Okay. Then next question somebody is asking, putting, what e-form filing are required with the ROC, RBI in connection with the issue of the subordinate debt? I think subordinate debt, as far as I understand, I think you'll have to report this as and where basis as per the RBI norm. I think there's a Prava portal is there, I believe. Am I correct, Pandey?
So not Prava portal, but we report in Cosmos, and we also have this other reporting system, so where we file all these things. And
Okay.
with respect to ROC, sir, it depends what kind of instrument that you are issuing. So if it is a private placement, if you're doing it, generally subordinate debt is nothing but unsecured debentures, So if you're doing that, and passing a resolution, so you may have to file MGT 14, you may have to file PAS 3 form. So that is how it is, General.
Yeah, correct. ROC things will arise as per the requirement of whatever the resolution passed by the board, based on the resolution, based on the if the security, etc. That will depends upon that. But coming to the RBI is concerned, yes, that is the question they are asking. Yeah.
Sorry, Aman, can you repeat, please? Sorry.
So if we are issuing subordinate debt, so what kind of returns, we may have to file? That is a question.
Subordinated for RBI, sir, no need to file. Best of my knowledge is only thing is it a part of the Tier 2 capital, which is a capital adequacy ratio return, where depending on the tenor of the NCD, they give some weight that if it's like more than 5 years, then you can have some 100% benefit in the Tier 2. If the maturity is coming closer, then you 100% benefit doesn't available, so it gets reduced. But best of my knowledge, there is no separate return going to the RBI for subordinate debt.
I think there's a gentleman called Santosh. He has written a nice presentation. Mail the copy of the same. There is a need for the discussion of the GST, RERA, PMEA, insolvency law, etc. and all that. Well taken your suggestion, Santosh. We will actually do. We'll be taking it various things which are actually relevant. And as I've been telling you also, our dissemination of this webinar is actually made on the YouTube channel, which contains the PPT. So PPT we are not sharing as such. So that I would like to inform you. Yeah, go ahead, Nine.
Yeah, thank you, sir. So, again, there are more guidelines given by the RBI. So, there is a framework for the flexible structuring of long-term projects to the infrastructure and the core industry. So, there the guidelines apply to specific to the non-deposit taking NBFCs. And the RBI introduced the new norms for projecting the finances, which become effective on October 1, 2025. So these directions lay out how the revised regulatory treatment for the changes in the date of commencement of commercial operations, or setting an overall ceiling for 3 years of the infrastructure project and 2 years for non-infrastructure projects. So these norms also establish a principle-based approach for the resolving assets in these loans, which is consisting of framework for all the regulated entities. There is a report.
Hemant, I think the same continuing the ESOP reserve and redemption reserve. I think Karthik is the person who has asked the question. He has actually come back saying capital redemption reserve or ESOP reserve is not a free reserve as per the SBR regulations 2023. So could you please clarify why it is actually included in CRER?
Vishal, you want to answer this?
So capital redemption reserve, I can say that if you refer the RBI return, which is a prefixed format where the NBFC need to go and only put the numbers. So there, if you see the Tier 1 capital, there are various line included. There are a lot of reserves, which are header is free reserve, and they are saying free reserve also includes the statutory reserve, general reserve, share premium, capital reserve, capital redemption reserve, debenture redemption reserve, credit balances in PNL, and other free reserves. So capital redemption reserve, that way they are considering as a free reserve. ESOP reserve, what we understand is if you go into the ESOP reserve, exactly accounting how it gets unwind. So ultimately, when the person is getting exercise the ESOP, ultimately it goes to the share premium. So by that way, logic, we can consider it's a free reserve only.
One more thing is also there, because no two regulation can be compared. We can discuss which is superior, which is inferior, why it is so, why it is so. Because different sectoral regulation have the different purposes. So whatever the sectoral regulation under which we are actually governed, I think you have to comply with it. That's what you actually said initially. Your format has actually specified this is what it is as per the line wise. So we'll have to go by that actually. I don't think we'll be able to ask other regulation says like that, why here, that sort of a thing. I don't think we should be able to do it. We'll have to comply with whatever the sectoral regulation applicable. That's what I think so. Any view, Hemant?
Yeah, I agree, sir, what you're saying. I agree to your point.
Yeah. Nine, go ahead.
Yeah. So, another framework is given under para 25 about the framework for revitalizing the de-stressed asset in the economy. And there is another framework given in the paragraph 26 that the given the guidelines on the liquidity risk management framework. So this is the crucial guideline that applies to the NBFC with asset size of 100 crores and above. And it is a critical component of the prudential regulation as it ensures that these institutions have adequate capital and liquidity to withstand the economic downturn and unexpected shocks. So the guideline make a specific exception for the certain type of NBFC such as type 1 NBFCs and non-operative financial holding companies and standalone primary dealers. So this triggered the application of the framework is a perfect example of the RBI's risk proportionate approach where the stringency of the regulation is directly correlated with the size and the systematic importance of the NBFCs. So now, as we have covered the broad frameworks and the specific guidelines, so there are two critical internal policies that the RBI mandates to ensure the sound corporate governance and the operational prudence. There are many more policies which NBFCs has to maintain, but in the prudential norms, there comes the two important policies which we have covered today. That is on policy on demand and or the coal loans and the investment policy. So in para 28 is the policy on demand, that is a call loans, and these are the loans that can be recalled by the lender anytime, and to ensure that the flexible lending is managed responsibly, the RBI requires all the NBFC that offers these loans to have a board approved policy. So the policy must clearly lay out the rules of the game, and it has the stipulate a cut-off date for the repayment, a review period of the loan, and the specific rate of interest. So the crucial detail here is, if the cut-off date is said to be beyond 1 year, the policy must include a written justification for this decision. So the rule is perfect example of the RBI's focus on transparency and accountability. And moving to the next policy that is given under paragraph 29 of the SBR. So we have the investment policy. So the policy is a mandatory for every NBFC, and its board of directors is responsible for framing and implementing it. So the policy is designed to bring discipline and structure how an NBFC manages an investment, which are a core part of its business. So as policy must be defined a criteria for classifying the investment uh, between investment into the current and the long term category, and it must clear out the rules for transferring the investment between these two classes, and so they must be done at the beginning of the half year and the explicit approval of the board. So this rules prevents the reclassification of assets to manipulate the financial statement. So as of now, we can say both these policies underscores the RBI's move to more hands-on, detail-oriented regulatory approach. So now moving to the foundational norms, how they apply across the different layer. Let's focus on some critical aspects of the financial strength, that is capital requirement for the middle layer NBFC. So these are the prudential norms for the middle layer now. As it shows here, the regulations are designed to ensure that these larger and more systematically important institutions have a robust financial foundation to absorb the potential losses. The key requirement is the capital adequacy ratio or CRAR. And all NBFCs in the middle layer must maintain a minimum capital ratio of 15% of their aggregate risk weighted asset. So the ratio, which includes both tier 1 and tier 2 capital, serves a crucial buffer against the financial shock. So there is a specific and stringent requirement for the composition of this capital. As you can see, the tier 1 capital, which is one of the core capital of the company, must be less than 10% of its risk weighted asset at any point in time. So the rule ensures that NBFC has a strong core of a loss absorbing capital. So it is very important to note that NBFC's primary engaging in the lending against the gold jewelry. So this tier 1 capital requirement is higher than even higher. That is 12%, reflecting the unique risk associated with their business model. To help meet these capital needs and regulatory requirement, the RBI also provided the option for the capital raising. So there is a one perpetual debt instrument for non-deposit-taking NBFCs. These can be used to raise fund that can be counted as a tier 1 capital up to the certain limit. And so this provision gives these NBFCs a value tool to enhance their capital base and maintain the regulatory compliance without diluting their equity. So these capital requirements are a clear example of the RBI scale-based regulation where it ensures the NBFC grows in size and systematic importance of its financial safeguards. So now there comes the capital requirement for the middle layer NBFC. So there is a concept beyond the simple ratio, that is internal capital adequacy assessment process, that is ICAP. And this is a significant addition to the regulatory framework. This is the part of a scale-based regulation and a powerful tool for institutionalizing the prudence from within the company. As you can see here, ICAP is a process which is a process by which NBFC is required to access its own need for the capital in a way that is commensurate with the risk inherent in its business. So this is not just about meeting the minimum 15% CRAR just we have discussed. It's about a company taking a hard look at all its risks, including credit, market, and operational risk, and ensuring that it has the capital to withstand them. So this process is a requirement for NBFCs in the middle and upper layer, and it is a designed on line similar to the ICAP prescribed for the commercial bank. So this methodology for this internal assessment is tailored to each institution, and as a assessment must be proportionate to the scale and complexities to the NBFC's operation. So it must be based on the policy that is formulated by the company's board. So we can say this means a very simple checklist won't do. The company must develop a bespoke, well thought out plan for managing its capital. The objective of ICAP is twofold. Like, first is it is to ensure that NBFC has adequate capital available to support all the risk in its business. And second, it encourages these institutions to develop and use a better internal risk management technique for monitoring and managing their risk. So in essence, we can say ICAP is designed to facilitate a continuous dialogue between the NBFC and the RBI regarding their risk assessment and the mitigation. It compels the NBFC to be proactive in its risk management rather than simply being reactive to the regulatory mandates. So there is a fundamental shift in regulatory philosophy. It moves the responsibility for capital planning from a simple compliance to a core strategic function of the business.
I think to the panelist, Karthik has actually come back. I think I see a point what he is actually saying here. Capital Redemption Reserve, that is CRR, is a statutory reserve created under the Companies Act, where the company redeems its preference shares or buyback shares to ensure the maintenance of the capital base, since the CRR is not mentioned in the list or eligible for the CET1 or the Tier 1 capital under SRR or RBI CRAR norms. It is not treated as part of the regulatory capital of CRAR unless there is a very specific RBI circular that makes an exception. None is found. I think when you say capital reduction reserve, when it is created for the particular purposes, that won't be actually coming here. If I understand correctly, the RBI CRR on the other hand is the minimum percentage of deposit that commercial banks must actually maintain, NPAs to maintain, etc., something like that. I think probably both the panelists can share their thoughts on this.
So I understand capital redemption reserve, nothing is specifically given under the Tier 1 capital as mentioned in the regulation. But only point coming from is the return what they have given for NBFCs to update for the Tier 1 and Tier 2. There it is mentioned. I understand both things are slightly contravention. We need to find it again. But yes, it is there in the return, but I agree it is not there in the regulation, specifically that CRR is part of the Tier 1.
Anything from Vishal?
So that was Vishal who said that. But
okay, sorry.
Yeah.
Sorry.
Yeah. So what Vishal is saying, see what Karthik is saying, but the return is, what is very clearly saying that, what gets included in calculating CRAR. So there may be some confusion. So see again, sir, RBI regulations are not very specific many times. You have to interpret lot. You have to, come to a conclusion. There may be two views. You may have to take a stricter view, but this is what Vishal shared is something which is from the returns that is there.
Correct, because what Karthik has written is a very, very valid point. I also agree with you being a company secretary, because you also will agree. The capital redemption reserve is created for the specific purposes. It can never be a free reserve. You're right, actually. But anyway, coming to the RBI, since I'm not very much familiar with the NPC companies, etc., when you say the line it is included, probably we'll have to go by that. Maybe any situation also we'll have to get if I clarified. That's what I will leave it there. Yeah. Okay, 9.
Yes, sir.
Go ahead.
Yeah. So now, as we have discussed about the critical capital requirement in the ICAP process, so let's understand about the fundamental measures of an NBFC financial resilience. This is CRAR, capital to risk weighted asset ratio. As it can see here that CRAR measures an NBFC's capital structure in relation to the risk it holds in its book, and it is the primary way of RBI to ensure that these institutions have a sufficient capital buffer to absorb the potential losses, and a minimum CRAR uh, of 15% is mandatory requirement for the NBFCs in the middle and the upper layer. So here you can see the formula is straightforward, that CRAR is calculated by dividing the total capital, that is tier 1 capital plus tier capital 2, and by the total risk weighted asset, and then multiplying that by 100. So let's understand that the tier 1 capital, it is considered the core high quality capital of the company, which includes the elements like paid up equity, share premium, statutory reserves, and the retained earnings. So for most of the NBFC, tier 1 capital must be at least 10% of their risk weighted assets. So this is the most crucial part of the capital base, as it permanent, immediately available to absorb the losses, and does not carry a fixed cost. Under tier 2 capital, this is a supplementary capital, as the slide as it indicates, that includes the instrument like subordinated debt, revaluation reserves, which are subject to the regulatory limits, and a risk weighted asset RWA, which is a key concept, that it is not just the total size of the NBFC's asset, it is the value of these assets after they have been adjusted for the inherent risk. So there is a crucial, as we have discussed about the CRAR, now we are moving to the risk-weighted asset.
In meantime, do you want Vishal, you want to highlight on how risk-based weight assets are calculated and how we
Yeah,
generally
you
do
can.
it?
Yeah, sure.
Yeah. So risk weight assets, when we are saying it's a on balance sheet and off balance sheet both. On balance sheet assets, generally for the middle layer, it's all 100% except some specific assets given in the regulation where it's a zero weight, like cash and bank balance. It's a zero weight. And suppose we have investment of GSEC, government securities, there also we have zero weight. And apart from these, those assets which are already netted off from the tier 1 capital computation, like group assets, group loans, where more than 10% of the own fund assets what we have removed from the tier 1 capital, to that extent those portion will also again here will be the zero weight, because double hit cannot come to the ratio. So that's the logic. And the remaining portion which not netted off from the own fund, that is having a 100% weight here. Apart from this, uh, for the off balance sheet, there are various kind of weight given, like 50%, 100%. So like commitment, contingent liability, those are the off balance sheet items where 100%, 50%, those kind of weight need to be put. And ultimately, this risk weight asset, which is slightly different from the balance sheet, because combination of off balance sheet, on balance sheet plus conversion amount, which go as a denominator in the formula compared with the tier 1 and tier 2 capital, and then capital adequacy ratio gets calculated, which requires to be more than 15%.
So this is a table which is, given on the assign a specific percentage which is weighted to each type of on the balance sheet asset. So it reflects the perceived risk of the default or a loss, if any. So let's look at a few examples to understand this better. Uh, so first, notice that the cash and bank balance have 0% weight. And this is because these assets are carrying the virtually no credit risk and are considered perfectly safe. And if we look at the investment section, approved securities also have a 0% risk weight, indicating they are seen as a highly risk secure. However, the bonds issued by the public sector bank have a 20% weight, so acknowledging a minimum level of risk. So the percentage increases to 100% for shares, debentures, bonds. And from the private sector, as these are considered to be carrying a significantly higher level of risk. Now, if we look at the current asset section, the table shows that a consumer credit exposure and a credit card receivable are assigned a high risk weight of 125%. So this is the powerful example of the RBI's risk proportionate approach, and it reflects the higher inherent risk associated with the unsecured consumer loans and a credit card dues. So this is a very core pillar of the RBI prudential norm, which ensures the stability in the financial system. So we have just, as you can see here on this slide, that RBI has a specific percentage weighted on each type of on-balance sheet asset. So first, we look at the category of the fixed assets, such as premises, furnitures, and the lease assets. So they are all assigned 100% percentage weight. And look at the other item of the other assets. You will see that there are certain items like income tax, deducted net interest due on government security. They have a 0% risk weight. So this is a key point. It is highlighted that the RBI consider these assets to be completely risk-free. And if we take the example of the domestic sovereign category, so this section is a powerful example of RBI risk-based approach when the fund-based claim on the central government and the state government security, they have a 0% weight. So this shows that lending to or holding a securities of the central and the state government is considered to carry no risk. However, the rule changes. Yeah.
Nine, somebody says, please show the last slide again.
Yeah.
I think she wants to go back one slide earlier. Right? Yeah. Is this the one you are referring? Nidhi? It's for you on your request. Okay.
So moving to this domestic sovereign, the rule changes for the state government guarantee claims. If the claim is not in default or it is overdue for less than 90 days, it is assigned a 20% weight. And this small percentage acknowledges the minimum level of risk you can see here. And if that some state government guaranteed the claim is overdue more than 90 days, this risk jumps to the 100%, and this aligns perfectly with the NPA classification norms, where a loan becomes a non-performing asset if it is overdue for more than 90 days, and the full risk must be accounted for. So here comes the treatment to the off-net balance sheet items for the capital ratio calculation. So these are the potential liabilities or exposures, such as a guarantee or a letter of credit, that not appear on the balance sheet but still pose a risk to the NBFC. As you can see here, RBI mandated a two-step process to calculate the risk-weighted credit exposure to these items. First, you must convert the notional amount into the credit equivalent, which is done by multiplying the amount of a specific credit conversion factor or by using the current exposure method. So this step essentially quantifies the potential risk of an off-balance sheet item, given a financial value that can be measured. So second, if you take this resulting credit equivalent amount and multiply with the applicable risk, just we do for the balance sheet asset. So risk weight appears applied here to the perfectly illustrated that RBI risk proportionate philosophy. And exposure to the central or state government, which is considered virtually risk-free, is assigned a 0% weight. So exposure to banks are given a 20% weight, reflecting a minimal level of risk. However, other off-balance sheet exposures which carry a higher inherent risk are assigned a 100% weight.
Somebody has put up a question. What are the consequences of the non-payment of the bonds on its maturity to the bondholders? What steps are available to the bondholder or depositors?
Generally, when company fails, it's an event of default. So event of defaults have to be dealt with in accordance with the documents, debenture bond document that is there. People can go to the debenture trustee or the trustees that they have appointed for, and it will be dealt in LCLT or the way it is to be dealt. So SEBI is also going to get into bondholders can approach SEBI. So it's an event of default. It's a big event, sir.
And another question has been asked actually. CRR can be used for the bonus shares and hence should be part of the equity tier 1 capital.
I think we have brought there's a lot of debate, on CRR and whether it is a free reserve or not, and all. We have discussed that. So we saw that though it can be, it may not be a free reserve, but RBI reporting structure is calling it as free reserve. So there's a conflict here. So let's not answer this. Otherwise, the conflict will go on.
No. One thing is there very clearly. What is the regulation says is okay, but the thing is reporting format, since the line says etc. that we are actually bound to report as per the line etc. That's what. But the actual whatever the situation comes, as Vishal puts it, we'll have to actually deal with it. Yeah. Okay. Go ahead, Nine.
Yeah, and second thing, I think Nikhil has given his view actually. I think he's just giving the second view that if it is used for the bonus issue again, then it should be part of the tier 1 capital. I think his belief is it should be tier 1 capital, if I'm not wrong.
Okay. Yeah. Yes, Nine.
So here, as you can see, we have given a table which, CCF varies widely depending on the type of instrument and the risk it carries. We have given few examples. Notice that instruments like financial and other guarantee, bill discounting, and shared debenture underwriting. So all have a CCF of 100%. So this is because these are a high risk instrument with a strong chance of being drawn upon. And 100% CCF means the entire notional value of the commitment is considered a credit risk for the purpose of capital calculation. And in contrast, look at the other commitment over 1 year. So they have a CCF of 50%, which is reflecting a lower, but still there is a significant level of risk is involved. So this is further distinguished from the short-term commitment and 20% CCF for the commitment up to 1 year. So finally, there is an important category which is unconditionally cancelable commitment without the prior notice. So these are assigned a CCF of 0%. So this is a very illustration of risk-free commitment, as NBFCs has the ability to cancel it anytime, effectively removing the credit risk.
And somebody is asking a question. What is the risk weight of the securitization asset or cash collateral securitization while calculating CRAR?
So Vishal, I can put something, but you can add if I'm not correct. So
Yeah,
for
Manju,
cash
go ahead.
collateral, cash collateral it would be 0% because it would be treated as low risk. Securitized assets would depend on the ratings, whether it is rated or it is unrated. So based on the rating, it would be. So that is what my view is. So if it is AAA rated, it would be around 20% or something. So, that it all depends on the rating, sir.
So my only limited point is securitization of assets which goes off from the balance sheet, if it is not part of the asset, because securitization says that transfer of the risk and reward. So if it is not part of the balance sheet, then there is no question of to consider as a risk-weighted asset. And second part is cash collateral securitization. So maybe it is coming out from the some off balance sheet guarantee, I guess. So if it is off balance sheet, then we need to refer the off balance sheet asset item, which is kind of commitment or something. So maybe it can fit between 50 and 100%. We need to check again that it's very technical. But my view is if it is talking about the off balance sheet, then we need to consider it accordingly. Securitization, I guess it's off balance sheet, so I think there is no question to consider that as a risk weight asset.
Thank you.
And
Yes,
if
Nayan.
we are, sorry, sir, again, one more thing. If we are on the other side, suppose if it is coming in the my balance sheet, suppose in the NBFC balance sheet is a purchaser, then it's 100%.
Okay. Understood. Yeah. Go ahead, Nayan.
So now we are on discuss this assigning the risk weighted average to the on balance sheet assets, and now the market related to the off balance sheet. Now we will continue with the discussion on how the RBI given the mandates to the treatment on the market related off balance sheet item for the capital ratio calculation. So these are exposures like derivative and swaps that do not appear on a company's balance sheet but still pose a significant risk to its financial health. So as you can see here, NBFC must consider all the market-related off-balance sheet items such as over-the-counter derivatives, repo and reverse repo agreements, and the CBLO when calculating their total risk exposure. So this credit risk associated with these items is not a simple concept. It is defined as the potential cost for the NBFC to replace the cash flow specified by the contract if their counterparty default. So this risk depends on the factor like the maturity of the contract and the volatility of the underlying rate. So the RBI given an example of these items, which includes the interest rate contract like interest rate swaps and futures, foreign exchange contracts such as cross currency swap, currency options, and the credit default swap. So this is this framework is very important exemption. For instance, instruments that are traded on exchanges with the daily to market and margin payments are exempt from the capital requirement. So this is a key to note that it acknowledges that daily settlement of these instruments effectively neutralizes the counterparty risk. And the exposure to the central counterparty, that is CCPs, it states that these exposures are assigned a zero credit risk. And this is a significant detail as it reflects RBI's trust in the clearinghouse mechanism because these exposures are fully collateralized on a daily basis and the central bank views them as a being virtually risk-free. So this approach, this approach which extends the capital ratio calculation beyond the balance sheet to include the market related exposure is ensuring that NBFC's capital is a true reflection of its total risk profile.
Hemant, somebody is actually asking, is there a difference risk weight of the securitization asset on the basis of the maturity period?
Vishal, you want to answer this?
Sir, as I said, that securitization of asset, if I'm selling this asset from my balance sheet, best of my knowledge is it's a off balance, it's going out of my balance sheet. So there is no question of any risk weight on it because it's not there in my balance sheet only. If it is coming in my balance sheet from the other party and I am the purchaser of that asset, it is securitized to me, suppose, then it has to be 100%. Then there is no maturity period criteria. What I understood is, Hemant, if you can add something.
Yeah, I go by what you say, Vishal.
Okay, Nayan, go ahead.
So now there is a one specific methodology which is used for these complex financial instrument, that is a current exposure method. So this is a method which is used to measure the capital charge for the default risk on a market related off balance sheet transaction. So it is comprehensive. That's two-step process that accounts for both the immediate and the potential future risk of a contract. As you can see here, the credit equivalent amount for a transaction is the sum of its current exposure and its potential future exposure. So the current exposure is the first part of this calculation. So it is the total gross positive market to market value of all contracts with the counterparty. And this is a measure of the current replacement cost if the counterparty were to default today. And the second part is the potential future exposure, which is a measure of the potential increase in the value of the contract over its remaining life. So this is a calculation by multiplying the notional amount of the contract by the relevant add-on factor. And there is a this is where the table on here on the slide you can see that the credit conversion factors as those add-on factors which serve as the add-on factors. So it provides a specific percentage here, and for interest rate contract, the CCF range from 0.5%, 50% for the contract for 1 year up to less than 3% for the contract over 5 years. So you can see a similar pattern for exchange rate contracts where the CCF is higher and starting at 2% and increasing to 15% for the contracts over 5 years. So the higher percentage for exchange rate contract reflect the higher volatility of a currencies compared to the interest rate. So as mentioned in the key rule regarding the credit default swaps, the NBFCs are only permitted to use these instruments to buy the credit protection to hedge the credit risk on the corporate bonds they already hold. So they cannot use them for the speculative purposes. So the step-by-step approach to calculating the risk on off balance sheet item is a clear example on the RBI's granular regulatory framework.
Vishal and Hemant, Karthik is asking, could you please clarify how to calculate the credit enhancement for the assignment securitization debt, that is cash collateral deposit for CRA?
Vishal, you want to answer that?
Yeah, so credit enhancement, there is a off-balance sheet item, line item given in the return itself, which requires a 100% risk weight, because credit enhancement considered as a off-balance sheet item, and which is required 100%. It is very well mentioned in the return format also. You can go and check the return format, and which is DNBS 03.
Yes, Nain, go ahead.
So again, there is a given the treatment for the deferred tax asset, that is DTA, and the deferred tax liabilities. When computing NBFC capital, so these again, these are the accounting detail that really impact the final capital ratio. And if we look at the deferred tax liabilities, either this DTL cannot be included in the either tier 1 and tier 2 capital, and it is not considered as the eligible capital item. So DTLs are created when a company's financial accounting income is higher than its total income, so resulting in taxes that will be paid in future. So if we look at the deferred tax assets, it is the opposite of the DTL. It arises when the taxable income is higher than the accounting income, which creating a future tax benefit. And both the rules for the DTA deduction must be, it must be deducted from the tier 1 capital if it is associated with the accumulate losses, and also the DTA net of the DTL. So as you see, moving to the very important pillar for the asset classification for the middle layer, the Reserve Bank of India mandates that every NBFC taking into account the credit weakness of a loan must, classify its asset into the specific categories. Again, there is a outline 4 key classes, that is a standard asset, substandard, doubtful asset, and the loss asset. So it is very important to note that assets cannot be simply upgrade from a stress category to the better one merely on the result of rescheduling or restructuring of the terms. So it must show that it is over the period of time the performance is satisfactory under the new terms for its upgradation. And this, the final pillar, IRACA framework, which is provisioning in how these classification directly impact the financial provision of the NBFC, must set aside, and we should look at those risk management procedures which we have already discussed earlier. So there is a 4 primary categories which we have already discussed about the asset classification. So standard asset again is an account with no default in the repayment of the principal as principal or interest. So it is a healthy loan that does not carry more than the normal risk. So moving to the main category, that is non-performing asset, that is NPA, which is a substandard asset. So the first NPA category is a substandard asset. That is, there is a loan account that has remained an NPA for up to 12 months that we have already discussed. Due to the time constraint, I'm just skipping this concept which we have already discussed about the SMA classification.
Yeah, you already explained this actually earlier.
Yes.
Yeah. Yeah, I think we are closer to 1 o'clock, huh?
Yeah, I was supposed to tell that. Okay.
Yes, Nain.
Yes, sir. So there are prudential regulations for the NBFC's upper layer, which is given under Chapter 13 of Section 4. So there is a common equity tier 1 that NBFC shall maintain an ongoing basis common equity CET1 capital for at least 9% of the risk-weighted assets, where this can be calculated as the given formula here in the slide. And there are some elements of the common equity capital which is to be maintained, and there is a regulatory deductions adjustment from the CET1. So for the upper layer, even the standard asset provisioning become more risk sensitive. So instead of a single flat rate, the provisioning percentage varies depending on the perceived risk of the asset classification. For example, we can see that standard individual housing loans require a provisioning of 0.25%. So, however, these advances to the commercial real estate sector requires a much higher provision of percentage for housing loans over to the teaser rates. And the provision is a very high 2.0 initially, and the differential approach ensuring the capital buffers are aligned more closely to the specific risk in their large and complex portfolios. So provisioning for the derivatives and current credit exposure from permitted derivative transaction with provisions like standard loan asset, they shall follow some conditions that imparting the allowances for the NBFCs net worth more than 250 crores. So they must follow these impairments for the allowances, which shall be included in the composition of the prudential norms. So here I can conclude the presentation, then we can open the grounds for the discussion and taking the questions. Thank you.
Thanks a lot, Nain. Excellent presentation. You have brought out all the concepts very well. Your flow was very good. You have done a very wonderful job. My great appreciation to you. One last question is appearing here. If the NPS is unable to maintain the net owned funds for any period for the year, whether NPSC license automatically cease to exist? I don't
So
think NBFC.
it won't cease to
Yeah,
exist. I believe it won't cease to exist, but RBI may come out with what we say an observation, which may go into adjudication many things. They may give a
generally,
chance to rectify, but they may
art,
give a penalty, and also it would be
yeah,
strictly observed.
yeah, automatically nothing happens actually. RBI will come back very heavily
Yeah, they will
first
issue a show cause
actually,
notice, and
and
they will
then they will
ask you to
follow the,
rectify.
yeah,
Karthik has
that's
put
right.
another
They might
question.
give the time also if there's a rectification, etc. That also they will, yeah, okay. Let me
Mr.
see.
Karthik has put one question
If
more.
debt equity ratio, yeah. If debt equity ratio is less than 7, then can declare the dividends.
So I think that we can take
If more than 7,
In the, and
separate chapter which would be covered in the dividend
yeah,
control.
there are session, Mr. Karthik. Wait. We have many sessions.
okay. Yeah, I think I have taken all the questions actually. If anybody has risen the hand, we can actually look at it.
Yeah, but relevant to today's presentation, please. There are
Yeah.
still more session on the compliances.
Yes. There are 2 hands risen I can actually see. I think one is actually Dhanashree Agarwal. There is one is there. Another is I think CS trainee. I don't know. Yeah. All the hands are there. You can unmute, you can talk, both of you.
You can take Dhanashree first so that one by one.
Yeah. Dhanashree, are you there?
Darshana Agarwal, Darshana.
Okay, Darshana Agarwal. Okay. Darshana Agarwal, are you there? You can unmute and talk. there's another gentleman, CS Training has put, that's a caption I can see. If you are also, you can also unmute and talk.
I think they have raised by mistake. No worries. You can go.
I think so, yeah.
Nothing. Yeah.
So I think we have answered all the questions. We can close the session. Yeah. So I think
Yeah, we can definitely.
Mr. Karthik raised the highest questions. I hope, Mr. Karthik, we have answered all, and still more to come. So you can raise more questions on that other topic as well. Nayan, excellent presentation. It was showing the preparation. I know, to be honest, she was busy on her other assignment, and she has to work overnight for this preparation. So, excellent effort. It was showing your preparation. Thanks. Thank you, Mr. Vishal. Your inputs of practical experience and answer to the tricky questions, handling that properly and with the satisfaction to our participants. Thanks a lot for that, for
Thank
your
you.
inputs and knowledge sharing.
Thank you very much.
Thanks, Heman, as usual, for all the attending our questions, answers. Thanks a lot for your time. Thank you, Mr. Bala. Thanks, participants. If anyone, panelists, want to say anything, then we will
So,
close the session.
yeah. I just want to add, ma'am, what we have done, till now, this is the third session, but the presentation, are always good. If someone wants to understand NBFCs, I think, this presentations, going through these presentations only will make them understand what NBFCs is. And if someone, talks after this presentation, the opposite party may think that, this person is an expert, because he knows many things from this presentation. So it is very well covered. Even Nayan has covered, very nicely in today's topic. So today's topic, if I want to summarize, prudential norms are not just rules, that we saw. It is like a foundation for trust, for stability, and for long-term growth of an NBFCs. So if NBFCs follows them, with discipline, they are protecting their business, they are protecting their customers and the entire financial system. So that is what RBI wants. Prudential norms are to be followed in spirit.
Yeah, thank you.
Vishal, you may conclude.
Yeah, Mr. Vishal.
Yeah, so the presentation was very nice by Nayan. It was very detailed one, and her approach to go line by line and to make the presentation very detailed is very good. And prudential norms is one thing. What my take is that we should strictly follow the norms. We should also understand something called as spirit of the law also, though it is not written sometime in the regulation. So things what we always discuss in the team, like things which are not allowed directly, we should not be try to do indirectly also.
Correct.
Yeah, rightly said.
So that is our common debate when we discuss so many times this dialogues are
because things get changed tomorrow. You
Right.
cannot take a blind turn or take a chance for anything. And we should not do such things also, because the organizations, as you said, we are systemically important, well connected. So problem to one can go to other also. So
Right.
we should stick to the governance. That's my take. Otherwise, it was very good session today. I hope that people have understood what I have replied and
Yeah.
satisfied with the answers.
Yeah. Thanks, Mr.
That's the
Vishal.
reason
And
I wanted
I hope
Vishal to
you
be a part.
enjoyed.
I
Because you
have
are
enjoyed this.
It was definitely it was definitely an excellent session. It was really, really value adding for me, because since I am revising it, because you are all actually in the 2013 Act. I think Dipti will recall. We are all unlearning 1956 Act. We are relearning 2013 Act.
Yeah.
So definitely it is a value addition to all of us. Thank you. Thanks a lot to everybody. My personal thanks to you, both panelists.
Thanks a lot. See you
Nayan,
next
once
week.
again, my great appreciation for the efforts what you have put in. Actually, excellent. Yeah. Thank you.
Thank you. Thank you,
Meet you
ma'am.
next week again
Thank
at
you,
another
sir. Thank you,
session.
Vishal, sir. Thank you, ma'am.
Thank you. See you next week. Bye.
Bye. Thank you.